Hello, welcome to Latest Wealth. I am Krishna Kailash, financial advisor as well as wealth coach. My dear friends, we have been learning about technical analysis. Earlier we discussed chart patterns, single candlestick patterns in three classes, multiple candlestick patterns 1 and 2, support and resistance and volumes. Now let us learn about moving averages. Moving averages are very important and you have to pay more attention here. This is little bit big chapter and this is a big class for you. My dear friends, we have learnt about averages in schools. Moving average is just an extension of that. You know average, just moving average is also like similar. Moving averages are trend indicators and are frequently used due to their simplicity and effectiveness. Before we learn moving averages, let's have a quick revision how averages are calculated. Assume 5 people are sitting on nice sunny beach enjoying the nice chilled bottled beverage. The sun is so bright and nice that each one of them end up drinking several bottles of the beverages. Assume the final count to be something like this. For example, serial number 1. Person, number of bottles. Serial number 1, for example, A, he took 7 bottles. B, 5 bottles. C, 6. D, 3. E, 8. So total number of bottles consumed is 29. Assume 6th person walk in to find out 29 bottles of beverages lying around them. He can quickly get a sense roughly how many bottles each them consumed by dividing total number of bottles by total number of people, correct? In this case it would be like 29 divided by 5, that means 5.8 bottles per head. So the average in this case tells us roughly how many bottles each person had consumed. Obviously there would be few of them who had consumed above and below the average. For example, person E drank 8 bottles of the beverage, which is the way above the average of 5.8 bottles. Likewise, person D drank just 3 bottles of the beverage, which is way below the average of 5.8 bottles. Therefore, average is just an estimate and one cannot expect it to be accurate. Extending the concept to the stocks here, just see here are the closing prices of ITC Limited for last 5 trading sessions. Last 5-day average close would be calculated as follows. For example, here is a date and closing. Date 14/7/2014, 344.95. 15/7/2014, 342.35. 16/7/2014, 344.2. 17/7/2014, 344.25. 18/7/2014, 344.0. Total is 1179.75. That is 1179.75 by 5 equal to 343.95. Hence the average closing price of ITC over the last 5 trading sessions is 343.95. The moving average, also called a simple moving average. Consider a situation where you want to calculate the average closing price of Marico Limited for last 5 days. The data is as follows. Date and closing price. 21/7/2014, that is 239.2. Next on 22nd, 240.6. On 23rd, 241.8. 24th, 242.8. On 25th, 247.9. Total is 1212.3. Average will be 1212.3 by 5. That means 242.5. Hence the average closing price of Marico over last 5 trading sessions is 242.5. Now let us move a little bit forward. The next day, that is on 28th July, 26th and 27th were Saturday and Sunday respectively. we have a new data point. This implies the new latest 5 days would be 22nd, 23rd, 24th, 25th and 28th. We will drop the data point belonging to the 21st as our objective is to calculate latest 5-day average. Date, closing price, just see here. Date is 22nd, 22/7/2014 is 240.6. Next on 23rd July, 241.8. Next 24th, 242.8. On 25th, 247.9. On 28th, 250.2. Total is 1223.3. So 1223.3 by 5 equal to 244.66. Hence the average closing price of Marico over the last 5 trading sessions is 244.66. As you can see, we have included latest data 28th July and discarded the oldest data 21st July to calculate 5-day average. On 29th, we would include 29th data and exclude 22nd data. On 30th, we would include 30th data point but eliminate 23rd data and so on forth. So essentially, we are moving to latest data point and discarding the oldest to calculate the latest 5-day average. Hence, the name moving average. Because what we are considering is we are taking only latest 5 days. So last 1 day we are removing. In above example, the calculation of moving average is based on the closing prices. Sometimes moving averages are also calculated using other parameters such as high, low and open. However, the closing prices are used mostly by the traders and investors as it reflects price at which market finally settled down. Moving averages can be calculated for any time frame, my friends, from minutes, hours, weeks, months or years. Any time frame can be selected from charting software based on your requirement. Of course, these you need not do physical calculations. A lot of softwares are available. If you want to get good software, search into Google. We are not going to recommend any particular software. For those of you who are familiar with Excel, here is a screenshot how moving averages are calculated in MS Excel. Notice how the cell reference moves in the average formula, eliminating the oldest to include the latest data points. Just see here. Here is the cell reference, date, close price, 5-day average and average formula. Just I am reading out. D3, 1st January 2014, 1287.7. D4, cell number is D4, 2nd January 2014, 1279.25. D5, 3rd January 2014, 1258.95. D6, 6th January 2014, 1249.7. D7, 7th Jan 2014, 1242.4. D8, 8th Jan 2014, 1268.75 and 1263.6. This is average of D3 to D7. Here 5-day average and average formula. 5-day average. Next D9, 9th January 1231.2 and 5-day average is 1259.81 and average formula is average of D4 to D8. Next, when it comes to cell D10, 10th January 1201.75, 5 days average is 1250.2, formula is average D5, D9. D11, 13th January 2014, 1159.2, 1238.76, average of D6 to D10. Next, D11, 13 Jan 2014, 1159.2, 1238.76. Average D6 to D10. Next D2's sell D12, 14 January 2014, 1157.25, 1220.66. Average of D7 by D11. D13, 15 January 2014, 1141.35, 1203.63. Average D8 to D12. D14, 16th January 2014, 1152.5, 1178.15. Average formalized average of D9 to D13. D15, 17 January 2014, 1139.6, 1162.41 equal to average of D10 to D14. D16, 20th January 2014, 1140.6, 1149.98 is a 5 days average. Formalized average of D11 and D15. D17, 21st January 2014, 1166.35, 1146.25 is equal to average of D12 and D16. D18, 22nd January 2014, 1165.4, 1148.08 equal to average of D13 into D17. D19, 23rd January 2014, 1168.25, 1152.89 equal to average of D14, D18. Now you see the moving averages changes as and when the closing prices changes. A moving average is calculated above is called a simple moving average, SMA. Simple moving average, SMA. Since we are calculating it as per last 5 days of data, it is called 5-day SMA. The averages for 5 days, or it could be anything like a 5 days, 10 days, 50 days, 100 days or 200 days, are then joined to form a smooth curved line known as the moving average line, and it continues to move as the time progresses. In the chart shown below, see here the 5-day SMA, standard moving average over ACC cement candlestick graph. See the line is visible. So what does a moving average indicates and how does one use it? Well, there are many applications of moving averages, and shortly we are going to introduce a simple trading system based on moving averages. But before that, let us learn about exponential moving average. What is this exponential moving average? Let us go into detail about exponential moving average. Consider the data points used in this example. Date, closing price. See the table. Date 22nd July 2014, closing price is 240.6. 23rd 241.8. On 24th 242.8. On 25th 247.9. On 28th 250.2. Total is 1214.5. When one calculates the average across these numbers, there is an unstated assumption. We are essentially giving each data point equal importance, meaning we are assuming that data point on 22nd July is as important as data point on 28th July. However, when it comes to markets, this may not always be true. Remember the basic assumption of the technical analysis. Markets discount everything. This means the latest price that you see on 20th July discounts all the known and unknown information. This also implies the price on 28th is more sacred than price on 25th. Going by this, one would like to assign a weightage to data points based on the newness of the data. Therefore, the data point on 20th July gets the highest weightage, 25th July gets the next highest weightage, 24th July gets the third highest, and so on. By doing so, I have essentially scaled the data points according to its newness. The latest data points gets the maximum attention and the oldest data point gets the least attention. The average calculated on the scaled set of numbers gives us exponential moving average EMA. I deliberately skipped the EMA calculation part simply because most of the technical analysis software let us drop on EMA on prices. Hence, we will focus on EMA's application as opposed to its calculations. Here is the chart of Cipla Limited. See here the chart of 50 days SMA, black and 50-day EMA, exponential moving average. Though both SMA and EMA for 50 days period, you can notice that EMA is more reactive to the prices and hence it sticks closer to the price. The reason why EMA is quicker to react to the current market price is because EMA gives more importance to the most recent data points. This helps the traders to take quicker trading decisions. Hence, for this reason, traders prefer to use EMA over SMA. EMA means exponential moving average over standard moving average or simple moving average. Now let us see the simple application of moving average. The moving average can be used to identify buying and selling opportunities within its own merit. When the stock price trades above its average price, it means traders are willing to buy the stock at price higher than its average price. This means the traders are optimistic about the stock price going higher. Therefore, one should look at buying opportunities. Likewise, when the stock price trades below its average price, it means traders are willing to sell the stock at price lesser than its average price. This means the traders are pessimistic about the stock price movement. Therefore, one should look at selling opportunities. Now we can develop a simple trading system based on these conclusions. A trading system can be defined as a set of rules that help you identify entry and exit points. We will now try and define one such a trading system based on 50-day exponential moving average. Remember my friends, a good trading system gives you a signal to enter a trade and signal to close out the trade. We can define the moving average trading system with the following rules. Rule number 1, buy. That means go long when the current market price turns greater than 50 days EMA. Once you go long, you should stay invested till the necessary sell condition is satisfied. Rule number 2, exit the long position, square up, or some people call it as a square off, when the current market price turns lesser than 50-day EMA. Just look here how the application of EMA. We are showing Ambuja Cements. The black line on the price chart is 50-day exponential moving average. Just see here. Buy 1 at 165, sell at 187. Next buy 2 signal at 178, sell 2 signal at 182, and buy 3 signal at 165, and ignore and sell at 215. Starting from the left, the first opportunity to buy originated at 165. Just look here. Just now I said highlighted on the charts at B1 165. Please notice and observe. At point B1, the stock price moved to point higher than its 50-day EMA. Hence, as per the trading system rule, we initiate fresh long position. Going by the trading system, we stay invested till we get an exit signal, which we eventually got at 187, marked as S1 at 187. This trade generated a profit of 22 per share. The next signal to go long came at B2 at 178, followed by a signal to square off at S2 at 182. This trade was not impressive as it resulted in a profit of Rs 4. However, the last trade B3 at 165 and S3 means sell at 215 was a quite impressive, resulting in a profit of 50. Here's a quick summary of these trades based on the trading system we have fair. Just see here, serial number, buy price, sell price, gain or loss, percentage return. First, buy price is 165, sell price is 187, gain is 22 rupees, percentage of return is 13%. Next, number 2, buy price is 178, sell price is 182, gain or loss is 4 and percentage return is 2.2%. Third, buy price is 165, sell price is 215, gain or loss is 50 and percentage return is 30%. From the above table, it is very clear that first and last trades were profitable, but the second trade was not so profitable. If we inspect why this happened, it is evident that during the first and third trade, the stock was trending, but during the second trade, the stock moved sideways. This leads us to a very important conclusion about the moving averages. Moving averages works brilliantly when there is a trend and fails to perform when the stock moves sideways. This is basically means moving average in its simplest form is a trend following system. From my own personal experience of trading based on moving averages, I have noticed few important characteristics. 1. Moving averages gives you many trading signals, buy and sell. During the sideways market, most of these signals result in marginal profits, if not losses. However, usually one of those my trades results in a massive rally like B3 at 165 trade, leading to impressive gains. 3. It would be very difficult to segregate big winner from the many small trades. 4. Hence, a trader should not be selective in terms of selecting signals that moving average system suggests. In fact, the trader should trade all the trades that the system suggests. Remember, the losses are minimum in a moving average system, but that one big trade is good enough to compensate all the losses and can give you sufficient profits. 6. The profit-making trade ensures you are in the trend as long as trend lasts, sometimes even up to several months. For this reason, moving average can be used as a proxy for identifying long-term investment ideas. The key to moving average trading system is to take all the trades and not to be judgmental about the signals being generated by the system. Now let us see one more example of BPCL, where moving average system suggested multiple trades during the sideways market. However, none of them were really profitable. However, the last trade resulted in 67% profit in all above 5 months. See here, multiple trading signals, market moving sideways, and BPCL moves from 350 to 583 in 5 months. One big trade, good enough to give you large profits. Now let us go into moving average crossover system. As it is evident now, the problem with the plain vanilla moving average system is that it generates far too many trading signals in a sideways market. A moving average crossover system is an improvisation over the plain vanilla moving average system. It helps the traders to take fewer trades in a sideways market. In a moving average crossover system, instead of usual single movement average, the trader combines two moving averages. This is usually referred as smoothing. A typical example of this would be to combine a 50-day EMA with a 100-day EMA. The shorter moving average, 50 days in this case, is also referred to as faster moving average. The longer moving average, that means 100 days moving average, is referred to as slower moving average. The shorter moving average takes lesser number of data points to calculate average, and hence it tends to stick closer to the current market price and therefore reacts more quickly. A longer moving average takes more number of data points to calculate the average and hence it tends to stay away from the current market price. Hence the reactions are slower. Just look at one chart of Bank of Baroda showing you how the two moving averages stack up when loaded on a chart. As you can see, the black 50-day EMA line is closer to the current market price as it reacts faster when compared to the pink 100-day EMA as it reacts slower. Traders have modified the plain vanilla EMA system with crossover system to smoothen out entry and exit points. In the process, the trader gets far fewer signals but chances of the trade being profitable are quite high. The entry and exit rules of the crossover system is as stated below. Rule number 1. Buy fresh long when the short-term moving averages turns greater than the long-term moving averages. Stay in the trade as long as condition is satisfied. Rule number 2. Exit the long position square off when the short-term moving average turns lesser than longer-term moving average. Let us apply the moving average crossover system to same BPCL example that looked at. Actually, for ease of comparison, I have reproduced BPCL's chart with single 50-day moving average. Notice, when the markets were moving sideways, moving average suggested at least 3 trading signals. However, the fourth trade was the winner, which resulted in 67% profit. The chart shown below shows the application of moving average crossover system with 50 and 100 days EMA. EMA means exponential moving average. See here, exponential moving average 566, 522, exponential moving average. The 50-day EMA crossover with 100-day EMA crossover at 380. The black line plots 50-day moving average and the pink line plots 100-day moving average. As per the crossover rule, the signal to go long originates when the 50-day moving average, that is short-term moving average, cross over the 100-day moving average, long-term MA. The crossover point has been highlighted with an arrow. Please do notice how the crossover system keeps the trader away from 3 unprofitable trades. This is the biggest advantages of crossover system. Now, a trader can use any combination to create MA crossover system. Some of the popular combinations for swing trader would be a 9-day EMA with 21-day EMA. Use this for short-term traders up to few trading sessions. Next, 25-day EMA with 50-day EMA. Use this to identify medium-term trade up to few weeks. 50-day EMA with 100-day EMA. Use this to identify trades that last up to few months. 100-day EMA with 200-day EMA. Use this to identify long-term trades, investment opportunities. Some of them can be even last for over a year or more. Remember, longer the time frame, lesser the number of trading signals. Here is an example of 25 into 50 EMA crossover. There are 3 trading signals that qualify under the crossover rule. See here. No need to say and mention clearly, just you can see the moving average crossover system can also be applied for intraday trading. For instance, you could use 15 into 30 minutes crossover to identify intraday opportunities. A moving aggressive trader could use 5 to 10 minutes crossover. You may have heard this popular saying in the market, the trend is your friend. Well, the moving averages helps you to identify these friends. Remember, moving average is a trend following system. As long as there is a trend, the moving averages works brilliantly. It does not matter which time frame you use or which crossover combination you use. My dear friends, let us revise what we learned. This was a little bit a big chapter. Let's revise what we learned. 1. A standard average calculation is a quick approximation of series of numbers. 2. In an average calculation where the latest data is included and the oldest is excluded is called moving average. 3. The simple moving average SMA gives equal weightage to all data points in the series. 4. An exponential moving average EMA scales the data according to its newness. Recent data gets maximum weightage and oldest data gets least weightage. For all practical purposes, use an EMA as opposed to SMA. This is because EMA gives more weightage to the most recent data points. The outlook is bullish when the current market prices are greater than EMA. The outlook turns bearish when the current market price turns lesser than EMA. If a non-trending market, moving averages may result in whipsaws, thereby causing frequent losses. To overcome this, EMA crossover system is adopted. In a typical crossover system, the price charts is overlaid with two EMAs. The shorter EMA is faster to react, while the longer EMA is slower to react. The outcome turns out to be bullish when the faster EMA crosses and it is above the slower EMA. Hence, one should look at buying the stock. The trade lasts up to a point where the faster EMA starts going below the slower EMA. The longer the time frame one choose for crossover system, the lesser the trading signals. My dear friends, please, if you are unable to follow, just watch 3 or 4 times. Don't feel hesitate. You must understand very well, because once you understand, learning is very, very important. After learning only, earning will start coming. That's why we are going step by step. Watch once again with more concentration. Initially it looks like a difficult, but afterwards very easy. Please remember, short-term pain, long-term gain. Short-term pain, long-term gain. For that, first is you must enjoy the process. More you enjoy the process, more results you are going to get. Enjoy the life. Be wealthy. Let's meet in next class. Till we meet again, enjoy every bit of life. Thank you. Krishna Kailas is logging off, and thank you and bye-bye.